Welcome to Corporate Finance. So we're going to look at selected questions in the 2013 paper, November 18th. Okay, question number 2. Been asked to discuss any 3 factors that influence dividend policy. What are any 3 factors that influence dividend policy? To start with, dividend policy refers to decisions that concern or guide the company regarding the amount, the timing of payments, or called the dividend to the shareholders. Now, it is very critical to understand that in this payment of shareholders, there are 2 key people that are at stake. There's management, who's directly involved with managing the wealth, and there are the shareholders who actually own this wealth. And so the choice of which policy depends on 2 key factors, internal and external factors. So the internal factors are to do with the stability of the earnings. Let me combine the internal and external factors. So the factors that really need to be considered are, number 1, how the stability of the earnings is. So if there's a stable and predictable earnings, there will be an option to be consistent in the dividend policy, where they could distribute a fixed percentage of the dividends as they should to the owners who are the shareholders. On the other hand, if companies have fluctuating earnings, they will adopt a residue kind of dividend policy where, firstly, dividends are distributed. Then after meeting all the investment obligations, that's when the residue is given to the shareholders. The other factors that they need to look at are what we call the growth opportunities. So the companies in their growth phase may prefer to retain all or reinvest all that which the business has made. Such companies will likely follow a low or no dividend policy. Now, this one is there to support future growth and expansion. Then the other factor has to be which kind of shareholders do we have, their shareholder preferences. So the company may consider the preferences of their shareholders. Of course, some may prefer regular, others may prefer all their dividends are paid. And as such, according to the sheet I gave you the following factors. So 3 primary reasons or options would be, number 1, to reinvest entirely everything back to the company for future growth. Number 2 will be partial distribution, which will require some dividends reinvested to fuel growth and others to pay the owners of the business. And the last option will be full distribution, where the entire income is given to the owners. So the appropriate decision of which dividend policy to adopt basically will be based on these 3 factors. The second part of the question is discuss the importance of corporate social responsibility when managing an organization. Discuss the importance of social corporate responsibility. Now, we must understand that social corporate responsibility here looks at a business poor approach to sustainable development by delivering economic, social, and environmental benefits to the stakeholders, especially the community. Now, there are various advantages that a strong social corporate responsibility may have. For instance, it may have an enhanced brand image. So if we're going to emphasize on corporate social responsibility activities, this will enhance the company's brand image and the reputation that it has, and also it may lead to customer loyalty and positive public perception. I usually give examples of the mines on the copper belt. We have Indeni, which we call Big Brother in dollar, because they're always available, even when government, and other stakeholders could call on for them to support. The other advantage of corporate social responsibility is the stakeholder trust and engagement. So using social corporate responsibility activities, it is imperative that trust and engagement are built with the stakeholders like the customers, employees, investors, and mostly the local communities. So this fosters long-term relationships and also the aspect of risk management. Integrating social corporate responsibility will mitigate certain risks that will be associated with the society, social governance of the law, safeguarding the company's long-term sustainability and the relations with government. And so, with that being said, in the preamble, I could also add to say corporate entities have not only an obligation to their shareholders, but also to the larger community. So in some countries, it becomes mandatory for them to apportion a certain chunk of their resources of profits to the community. These activities could range from education, healthcare, sanitation, and conservation. So even in the absence of the law, many reputable organizations should engage in social corporate responsibility. So this will foster the three things that I've talked about. Number one, enhance brand image. Number two, enhance trust. And lastly, it will also ensure risk management. Certain companies, even the society, will not steal from them because they know these guys take care of us. So this was for 6 marks. So question part C, a colleague of yours recently retired and wants to start a business, but she's unsure of what business to start up. You're advised to give your colleague the different forms of businesses, their setbacks, and the advantages. So we have a sole proprietorship. It's a one-man business. What other advantages can you say about sole proprietor? Anyone? Okay, so I've been talking about this over and over. You need to have an idea of these 3 forms of businesses. This is just in chapter 1. So sole trader is a one-man business. Advantages of that, there's easy setup. So sole trader is a straightforward and easy setup kind of arrangement. Let me just beam some of my notes. So he enjoys all the profits. Number 1. Number 2, it's easy to start up. Number 3, he pays only one type of tax, personal income tax. Okay. Number 4, he has full control. And he does not have to consult anyone for his decisions. The advantages here are that he has unlimited liability, meaning his personal belongings are responsible for the business debts. He has limited resources because he faces challenges in raising capital being alone, and there's limited growth potential because of the scalability and expansion and the capacity of the resources. So that is about what you could tell this friend of yours about the businesses before venturing in them. So we have another kind of business which we call partnership. Partnership is a business where 2 or more will merge, and these ones will form a pact where they're going to share the roles of who does what and how much profit should be shared and how much capital must be shared. Advantages are that there's sharing of decision, which become quality because you collaborate, you storm. There's shared financial burden because partners will contribute. There's also access to resources where partners will benefit from a broader pool of resources, including their skills. The disadvantages for partnership is that of sharing profits, which is sometimes not nice. There's potential personal conflicts which will disrupt management style, and a limited liability, like it is the sole proprietorship, where partners will have to make due personal assets when the business is vulnerable. So that is on the third business structure second business structure you can tell your friend about. Then we have a corporation or a company. In Zambia, the law under Cap 388 instructs that whenever a company is into corporation, it becomes a different personal entity. This personal entity can sue and be sued. So advantages are that the personal assets are protected, so there's limited liability. Number two is that there's easy access to capital because companies can raise funds by issuing stocks in the market through the exchange. And also there's perpetual existence because the business doesn't die upon death of an individual. Disadvantages is complex and costly to set up. There are a lot of legal formalities. There's double taxation here. Profits are taxed. And when they're distributed shareholders as dividends, they're also taxed on personal capacity. So also the extensive regulatory requirements, corporations are subject to the law, publishing, record keeping according to the standards, financial standards. So that is how this question is supposed to be answered, unless there are any additions to that. Okay. So we go to another question. Okay. This part, distinguish systematic and unsystematic risks. Okay, we discussed this yesterday in depth, but I could still add again. What is systematic risk? What is unsystematic risk? So I said systematic risk has to do with what? With the market. It's also called the market risk because it affects the entire market, not a particular segment. So it is an inherent kind of risk which cannot be diversified. The factors may include interest, inflation, political instability, macroeconomic activity, and these impact a wide range of assets, so it cannot be diversified. And systematic risk, on the other hand, which is also known as specific risk, is unique to a specific asset or a small group of assets. And this one can be mitigated by diversifying with associated companies. For instance, if we know in the mining sector and Sujulite is not being granted a license to go out, so you could diversify and do other minerals. So also there are other factors that may affect this kind of risk, like management, labor strikes, product recalls, like this Sujulite. This can only be reduced or eliminated by what? Diversification. So the statement, only market risk matters to a diversified investor. So this implies that a well-diversified investment portfolio or only market risk or systematic risk is of significance to an investor. So unsystematic risk can essentially be eliminated through diversification. So this is a viewpoint that you must hold, that a diversified portfolio with different assets, industries, or geographical regions, an investor can minimize the impact of unsystematic risk. So I hope this is very clear. I have put some solutions in here that will help you. All right, 4 factors a company must consider when. So this paper also had I think some poem in it, AOQ. Those of you who got a copy, you can go through and the calculations. We'll look at the calculations during the day. Today we have a whole morning for calculations. So what are some of the factors that a company must consider in ascertaining dividend policy? So I've mentioned the earnings and profitability. The company should consider their earnings and profitability trends before deciding which policy to adopt. The capital requirements and investment opportunities. So companies will need to evaluate their capital requirements. So these are the key 4 key factors. Let me just spread them so that we can quickly read them through. So I've talked about what? The earning and profitability. Number 2, the capital requirements. Number 3, the shareholder expectations and preferences. Number 4, the legal and contractual constraints. So these are the factors that should be looked at before establishing which dividend policy to go about. So by earning and profitability concern, the company needs to consider the trend. So when they want to decide which policy to adopt, if there's a stable and consistent earning stream, then companies can have an even payout. The capital requirements and investment opportunities, a company must evaluate their capital requirements for future investments of growth. So if a company has a profitable investment projects for the future, it might now retain more earnings rather than distributing them as dividends. On the other hand, if the company has fewer profitable investments, then they may opt for higher dividend payout to distribute excess cash to shareholders. The other factor is the expectations of shareholders and preferences. So understanding what the shareholders want is crucial in determining what policy to adopt. So some shareholders are income-oriented, so they may prefer regular and stable dividend, where others are concerned about the growth of the business, so they would want the business to be stable and more profitable. And last is legal and contractual constraints. So companies will need to consider the legal and contractual obligations when formulating their dividend policy. So various legal constraints such as regulatory restrictions may influence the amount and timing of these dividends. So we could answer this question for 12 marks in that broader perspective. So solutions are in this copy. I have done a number of papers and answered them just for you to follow through. Okay, write brief notes on managing meaning and significance of the following terms. Internal rate of return, what is it? It is a crucial financial metric that is used to assess the profitability of an investment. So IRR represents a discount rate that makes our net present value of a project to be equal to 0. So IRR measures the efficiency of an investment considering time value of money and the cash flows being generated over time. So if the IRR is more than the cost of capital, then the project is generally viable and acceptable. If it's below, then we can say this project is not viable. Beta alpha, what does it mean? It measures volatility of unsystematic risk associated with a stock in comparison to the overall market. So beta helps investors to evaluate the stock's sensitivity to the market movements. So you must understand that the beta will range between -1 and +1. Okay, if beta is more than 1, it can be more than 1. If beta is more than 1, it means this product is more volatile. When beta is less than 1, it means that there's less volatility, less risk. So, and the beta could be exactly 1 as well. So a beta of 1 implies that the stock volatility is in line with the market. So investors can use the beta factor to make informed decisions about buying or selling based on their risk tolerance. Portfolio theory provides a framework for risk-averse investors to construct portfolios that will maximize the expected returns. So for instance, in a given level of market risk or minimum risk for a given level of expected return, the portfolio theory will emphasize the benefits of diversifying and also a trade-off between risk and return. So this theory will suggest that investors can reduce portfolio risk by holding a diversified mix of assets that are not perfectly correlated. So understanding this theory will help manage the relationship between risk and return, because we know investors always want to achieve a higher return. Systematic and unsystematic risk refers to the degree of uncertainty of inherent risk that can either affect the entire market or part. So such factors could be diversified and undiversified factors. So the diversified, the undiversifiable factors are those that affect the market, like interest rates, political factors, and economic fluctuations. When you're dealing with unsystematic risk, which is also known as specific risk, this is individual risk that affects a particular stock and can be mitigated through diversification, and it is not related to the overall market. So understanding the distinction between the two types is very important for an investor. What is coefficient of correlation? This one measures the degree of the relationship between the two investments, and it ranges between -1 and +1. So the strength and direction, like we used to do in quantitative methods, is measured by this coefficient of correlation R. So if you have -1, it implies that these two are perfectly negative. If it's +1, they're perfectly positive. So they move in the same direction. So we need to understand the coefficient of correlation to help investors assess the relationship between two investments and to make informed decisions about the portfolio in terms of diversification and risk management. So we end here for today. Have a pleasant day.